Investment types and how to choose the best ones. Have you been interested in investing but don't know where to start? Investing is a great way to grow your money. But it can be a little intimidating, especially if you are a beginner investor. That's why we created this video to help you get started. In this video, we'll go over the basics of investing in the stock market. We'll also talk about what you need to know about the different types of investments between stocks, bonds, mutual funds, index funds and ETFs. Now, if you are enjoying this video, please don't forget to smash the like button and subscribe for more videos like this. Also, make sure you click on the bell to turn on notifications. The meaning of investing. Investing is the act of committing money or capital to an endeavor with the expectation of obtaining an additional income or profit. In easier words, investing is the process of putting your money to work so that it can grow and provide you with more money in the future. Investments come in many different forms, including stocks, bonds, mutual funds, index funds, ETFs, real estate, precious metals and other types of assets. There are many ways for you to make investments: through a bank account, retirement account, like a 401k, brokerage account, like Fidelity, and more. Investing involves risk, including potential loss of principal. Investment is a broad term that can mean a variety of things. To some people it may be about making a quick buck, and to others it may be about securing their future. It all depends on what your goals are and how you want to achieve them. But generally speaking, investments are considered as long-term financial commitments. The first step in investing is deciding what type you want to pursue. How to know which investment is right for you. One of the most important decisions you'll make is determining how to invest your money. However, there are so many options out there that it can be difficult to know which one is right for you. When it comes to investing, the type of investment matters, and we want to highlight some of the key differences between stocks, bonds, mutual funds, index funds and ETFs. In order to understand the differences between these investment vehicles, it is important to first understand what each type of asset does. Stocks, bonds, mutual funds, index funds and ETFs all trade on the stock market, and each one has a different function. Mutual funds. Mutual funds are baskets of securities that investors can buy and sell like stocks or bonds. Mutual funds are a type of investment that pools together money from many investors and invests it in stocks, bonds, short-term money markets and other securities in order to meet the specific goals of their investors and maximize shareholder returns. Mutual funds are investment funds that are managed by professional fund managers and often sold by a financial advisor. They can be actively managed or passively managed. Mutual funds are generally more expensive than index funds, but they have the potential for higher returns. Index funds. Investing is a great way to make your money work for you, but it can be difficult to know where to start. If you are new to investing, the best place to start is with index funds. Index funds are low-cost investments that track the movement of a particular market index. They're typically considered more conservative than other types of investments like individual stocks or bonds, but they also have the potential for greater returns over time. Index funds are designed so that investors don't need to worry about picking individual stocks or bonds and trying to predict which ones will do well in the future. Instead, they're diversified across many different companies and sectors, so your investment will do well no matter what happens in any one sector or industry. Index funds tend to be cheaper than mutual funds and provide a return similar to the market, which means they can be more predictable with lower risk. Stocks. Investing in stocks can be a great way to make money, but it is not for everyone. If you are interested in investing, it is important to understand the risks and rewards of this type of investment. A stock is a type of security that represents ownership in a company. You can buy stocks on the stock market or through an investment broker. The price of a stock fluctuates with supply and demand. If there is more demand for the company's stocks than there are available shares, then the price goes up because people are willing to pay more for it. If there is less demand for the company's stocks than there are available shares, then the price goes down because people are not willing to pay as much for it. Investing in stocks is not a new concept, but the world of investing has changed dramatically over the years. Stock prices are no longer just determined by supply and demand. Nowadays, there are many different factors that affect stock prices. Bonds. Bonds are a type of debt with a fixed interest rate, where the issuer owes the holder money from borrowed funds. Bonds are a type of investment that pays a fixed interest rate for a certain amount of time. Bonds are traded on the bond market and can be bought from different financial institutions. There are different types of bonds, and each has its own features and risks associated with it. It is important for investors to understand what these features are before deciding which bond to invest in. The most common bonds are government bonds, corporate bonds, and international bonds. Government bonds are issued by governments to finance their borrowing needs. Corporate bonds are issued by companies to borrow money from investors for specific projects. International bonds are issued in different currencies with the aim of diversifying risk across international markets. Investors typically buy bonds because they offer higher yields than savings accounts or certificates of deposit, but carry more risk. Bonds are the simplest way to invest in the stock market. They are easy to understand and give you a predictable return. There are two types of bonds: secured and unsecured. A secured bond is backed by collateral, which is why they are considered to be safer than unsecured bonds. An unsecured bond is riskier because it's not backed by anything tangible, other than by the creditworthiness of the issuer. ETFs, exchange-traded funds. Exchange-traded funds, also known as ETFs, are a type of exchange-traded security. They function like mutual funds, but can be traded on the stock exchange. ETFs are investment funds that track a particular market index or sector and can be bought by investors who want exposure to those markets without having to buy the individual stocks in the index. The idea behind an ETF is to provide investors with diversified exposure to a stock index, commodity, or other asset class at a low cost. ETFs are traded on exchanges and can be bought and sold throughout the day like stocks. The ETFs can be classified as equity-based ETFs or fixed-income-based ETFs. The first includes equities like stocks, mutual funds, and similar securities, while the latter includes bonds like government securities, corporate bonds, and similar securities. As seen, investing is a way to put your money to work for you. You can invest in stocks, bonds, mutual funds, index funds, ETFs, and other types of investments that give you the opportunity to make more money over time. Investing can be an exciting and rewarding experience, but it also carries some risk. Investing in the stock market is not for everyone. You need to have a high risk tolerance, and you should be prepared for the possibility of losing money. However, if you are willing to take on that risk, there are many benefits to investing in the stock market. Please don't forget to smash the like button, subscribe, and click on the bell. It will help me a lot. Thank you for watching, and I'll see you on the next video.